What is smart investing and how to do it? Smart investing extends the fundamental principles of investing. It involves making the right investments that suit your needs and help you reach your financial goals. It is easy to choose the wrong financial product from the plethora available. Smart investors know how to manage your money and time effectively. Smart investing allows you to do three things. 1. This allows you to create an additional source for income. 2. Provides for long-term financial security. 3. This helps to create enough post-retirement wealth. These are the top 10 ways you can become an intelligent investor. Consistent investments. It is not enough to invest once a year or even sporadically. You must invest a set amount each month or quarter to ensure your money grows well. If you want to achieve your financial goals, it is important that you maintain financial discipline. This practice can be followed by auto payments and systematic investment plans, SIPs. These options will ensure that you have a set amount each month. Start investing early. You can gain an advantage by investing as soon as your earnings begin. Even if you've reached that point in life, investing early can give you an edge. Early investment can ensure that your money is able to grow into a large corpus fund that will be useful in times of need and when you retire. Do not underestimate the power of compound interest. Time is an investor's greatest asset. It is important to make the most of it for financial gain. It is not enough to invest to earn returns, but also to spend the money to build wealth. You can build a strong financial portfolio by reinvesting the interest earned. Create a diverse portfolio. It is still true that you shouldn't put all your eggs into one basket. Diversifying your investments can reduce risk and help you avoid financial losses in the event of volatility. One of the most striking examples is the COVID-19 crisis, which caused economic instability. Investors who had concentrated their money into one kind of stock faced heavy losses as opposed to those who rather diversified their portfolio. It is always best to diversify your investment portfolio into different asset classes. Develop a risk appetite. Although this may sound like an obvious step for large corporate companies, it's an important one for all financial investors. While risk is a part of investing, one can decide how much risk they are willing to accept. Keep in mind risk tolerance while setting your financial goals. It is crucial to know your financial tolerance and the limit of financial losses that you are able to sustain. Do not chase the highest return. It doesn't necessarily mean that you should get the best possible returns over a short time. Smart investing teaches us that steady, low-risk investments that are made over a long time period are the ones that will grow the most. Keep track of your investments regularly. Investments require a lot of care and attention. It is important to track your money. To track and analyze performance, create spreadsheets with all of your investments. Monthly expenditure reports can be a great way to improve saving strategies and determine how much liquidity you need. These little things can be combined to create a solid financial management system that will keep you in good stead for the future. Learn to educate yourself. It is essential to understand the basics of the stock market before you venture into it. Knowing the intricacies of stock trading will allow you to make better financial decisions. For other investments, you should keep abreast of new financial products and consult investment books written by industry experts. It will pay off long-term if you have a good knowledge of financial news and a habit of learning something new about investing every day. Patience is a virtue. We can find comfort in the proverbial wisdom. Good things happen to those who wait. The same principle can be applied to financial matters. Investors are primarily looking for immediate returns. This can lead to financial disasters. Instead, invest as a long-term investment because it is more profitable. Healthy profits take time. Avoid the herd mentality. In his seminal book, The Intelligent Investor, Benjamin Graham states that even the most intelligent investor will need to resist following the crowd. It is easy to see what others are doing when making financial investments, but that might not always be the best path for you. Financial goals are subjective. They depend on your risk tolerance, vision for wealth, and family needs. There is no single approach that works for everyone. It may not be wise to follow the lead of everyone else. There are some best online money-making offers given in the description, so don't forget to check them. If you liked the video, then like and share it and give your opinion through a comment. If you haven't subscribed to this channel yet, then do it now. Also press the bell icon so that you can get notifications of my future videos.